And Neil, I was going to wait to bring up MMT, modern monetary theory, but basically last decade, last expansion, there was a sense that you could do almost anything and it wouldn't move the needle. Well, now we know there's a number at which it moves the needle and maybe moves it too much.
Yeah, I think if you had asked me a year ago, what would have happened if we had done in 2009 some $3 trillion stimulus, some massive influx of dollars into the economy, I would have assumed that would have all gone into higher growth. It would have, been to Barack Obama's political benefit, things like that. What we're seeing now, a lot of money gets spent. If that all goes into inflation rather than real growth, it's not good for people's sentiment about the economy, and it's not creating a better standard of living. It just flows into shortages, inflation, all the stuff we're dealing with right now.
So, Neil, the irony is that the sort of concern that the economy can actually run too hot comes at the very time that the Fed had decided maybe it was okay to run too hot, depending on, overshooting to make up for previous undershooting of the inflation goal. Now you have to wonder about that new Fed goal itself.
Yeah, I think that's right. They set up this new flexible average inflation targeting framework in 2020. In some ways, that might have been fighting the last war. In some ways, they were dealing with an issue of prolonged below-target inflation. That's certainly not the problem we have now. And there are some reasons to think, and Chair Powell alluded to that earlier today, there are some reasons to think that may shift in some long-lasting ways that we have to monitor really carefully.
When you talk about the speed of the recovery, the circumstances between 2008-9 and 2020 were very different, and the accompanying pain was very different. We did not have the supply chain or the supply shortages back then that we've had this time, and yet we just threw money into the thing. It's a different set of circumstances, but I don't dispute the idea that maybe we've come back too fast from what was really a full dead stop of the U.S. and global economy there in 2020.
Yeah, I agree with that. Like, totally, the pandemic is a completely unique experience. There are a lot of things about this last year that are really unusual in any kind of economic experience that any of us have lived through. I will say, though, 10 years ago, 12 years ago, there were a different set of issues and a different set of problems. There was a structural reallocation away from housing, away from durable goods, so kind of the inverse of what we had in 2021. So, yes, if they had done a bigger stimulus in 2009, I do think there would have been higher real growth and a better labor market. That said, we don't know quite how far they could have turned that dial, policymakers writ large, without really running some of the same types of frictions that we're experiencing right now.
Yeah, and again, you're saying, Neil, with all of this, obviously the Fed has a green light to keep hiking, and look what we just heard from Chair Powell where you are.
Yeah, I think that's right. If you look at any kind of market indicator, this is not a situation like late 2018 when you remember they announced a rate rise and forecasted more rate increases, and the markets just freaked out. You had bond yields fell, you had equities fell. You have a lot of sentiment also among economists, among kind of people in this room. This is the National Association of Business Economics, where the feeling is they're behind the curve, they have room to tighten. Let's go for it.
Yeah, Neil, thanks for giving us some time today. It's good to see you.
Shepard Smith here. Thanks for watching CNBC on YouTube.